Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have John Davi, CEO, CIO, and founder of Astoria Portfolio Advisors. We're here to discuss an actively managed equal weight ETF using quant metrics to pick large and mid-cap US stocks. It's great to have you with us, John. Welcome to Trade Talks.
Thank you for having me.
Tell us more about ROE. How are you employing quant metrics to build this portfolio?
Okay, so we take a broad universe of like large and mid-cap stocks. So we start with, let's say, thousands of stocks, and ultimately we filter so we get 100 of the highest quality stocks, and we equally weight each one of them at 1%. So we pick 100 of them, equally weighted, and then we optimize against the S&P sector weight. So if the S&P has 28% tech, we're going to have 28% technology exposure in our ETF.
Let's talk about the historical performance of equal weight versus market weight. Of course, right now everyone's talking about the Mag 7 and the concentrated exposure that has to the indexes. From a historical perspective, what tends to outperform the other?
Okay, so it's fascinating. You would never expect this, but the equally weighted S&P index has dramatically outperformed the S&P 500 index since the indices were created, let's say going back to 2000, which this is like the S&P index provider as a index calculation agent. So there's like 400 basis points of outperformance for equally weighted compared to market cap weighted, over the last 20 years. So that compounds over time, and that's pretty powerful. And it makes sense, right? Because as markets go up over time, you'd expect small and mid to outperform large.
So how would you use ROE in a portfolio?
Okay, so that's a good question. So the reason why we launched ROE is because we were worried about the Magnificent Seven stocks, and you definitely have a rationale from like an earnings standpoint, a valuation standpoint. They are truly very good businesses, but the point is that like they are dominant in the indices. It makes up 30% of the S&P 500 index. So we said, look, we don't want to sell all of it, but let's take a third of our market cap weighted exposure, and let's create our own equally weighted ETF that gives you exposure to high quality stocks. So we take like a third of our large cap core ETF that we held in our own ETF model portfolios to buy ROE. The problem with like the standard market cap, the problem with the standard US equity indices that equally weight is that they will basically have only like 15% exposure to tech, and we didn't like that. So we wanted to like match the S&P tech sector weight. So that's why we launched it, is that we get equally exposure, 100 of the highest quality stocks, and we're going to match the S&P sector weight. And you can't get that with the existing index products out there. That's why we launched it.
Appreciate the insight, John. Thanks for joining us on
Thank you.
Trade Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.